Quick reminder to use coupon code CYBERKEVIN for the best pricing on the programs on building your wealth. A link down below. Anything from real estate to stocks, building a YouTube channel, and sales.
Hey everyone, me Kevin here. Okay, so we gotta give an update in terms of this whole recession noise that we keep hearing about, because this week we're going to finally start getting a lot of clarity, which is really important. We've got quite a few important things coming up this week. Let's talk about those now. But first, a look back at this last week. We just lost 6% in the S&P 500 in 1 week. We are up 8% from the lows, but we basically almost gave back half of that, right? There's a lot of confusion because there's no clear signal. I mean, we've got the inversion of the yield curve, then it uninverts, and then it goes back. It's back and forth. You've got the 10-year yields that are going absolutely ham. I think we're at over 2.7 now. And, of course, you've got a lot of people maintaining higher shorts on all sorts of equities right now. Why? Because there's fear. There's fear that the market is going to fall further and that we will fall into a recession. Right now, recessionary odds are at 27.5%. And the biggest thing to prevent that is going to be the consumer. So we're going to talk about that. But first, let's talk about what's coming out and the clarity that we're getting this week. On Tuesday, we're going to be getting our CPI report. Economists again boosted their inflation forecasts for this CPI report and for inflation expectations for the rest of the year. Get this, we were at the beginning of the year expecting inflation would be about 4.5% at the end of 2022. That means a nice kind of curving down. Well, now economists are forecasting that inflation will be 5.7% in the last 3 months of 2022. Pretty high. And they've downgraded growth expectations for the rest of 2023, which is also wild because now we're thinking this is going to last not just 2022, but also throughout 2023. We do have the CPI report that comes out Tuesday, and that CPI report, because I just referred to a survey leading up to the CPI report, CPI report is expected to show month-over-month inflation of 1.2%, which is absolutely the highest month-over-month number that we've had in over 40 years,
Which annualizes to 14.4% of inflation. That's wild.
However, the core inflation year over year is expected to be consistent somewhere around 5.5%. I think everybody's going to be looking at that core number, not so much that headline number, which is probably going to be 8.5 to 9%. Bloomberg forecast right now is sitting at about 8.5%. That core number strips out gas and foods, which obviously are extremely volatile because of what's going on in Ukraine. So, what's the market going to look for Tuesday? Hopefully, a stable core inflation read. If that inflation read comes in hot and we get something like a core of 6 or 6.5%, the Fed's going to have all the ammo they need to keep crushing this market.
Thank you to today's sponsor, The Motley Fool. Are you tired of seeing others get rich in the stock market? Well, let The Motley Fool help you. Motley Fool Stock Advisor is a subscription stock picking service where members gain access to the Motley Fool's library of expert stock recommendations, which are carefully aimed at multiplying members' net worth. Members receive stock picks every month from legendary investors. There are over 1 million investors using the Motley Fool Stock Advisor to find high conviction stocks, and it's been ranked as the #1 newsletter by Wall Street Survivor for 4 years in a row. We all know that stocks go up and stocks go down, but the Motley Fool believes that over the long term, anyone can build a nest egg they need for early retirement, dream vacations, or whatever they may find fulfilling in life. Whether you're just starting out or you're an experienced investor, the Motley Fool has the tools to help you build out a well-diversified portfolio. Financial freedom could be right under your nose. And today, the Motley Fool is offering its top stock picking service to new members for just $99 for the entire year. That's less than $10 per month. Visit fool.com/Kevin to access this special offer. They also just released a new article, 5 forward-looking stocks under $50 that you can read for free at fool.com/Kevin. Invest better with Motley Fool Stock Advisor.
And that's ultimately what they're doing, is with their words and, of course, their actions, which will be to follow, they are stripping demand out of this market, driving that 10-year Treasury yield up, driving up mortgage rates, and reducing the consumer's ability to use their homes for cheap financing, increasing the costs of housing, increasing the cost of cars, not yet increasing the cost of credit cards, though, which is really interesting. Credit card interest rates were an average of 16.3% January 1st. Right now, they're at 16.4%. They haven't moved at all. So that means that shock of higher credit card interest rates are still to come, and that could strip out some more consumer demand. So we got to pay attention to that. So core CPI, that credit card shifting in interest rates, and of course, it's going to take probably 6 months for us to actually see the consumer react to these higher rates, especially with real estate. That takes time, though we're already starting to see the impact. Now, another thing that we're going to look forward to this year, this week, earnings on Wednesday. On Wednesday, JP Morgan reports earnings. This is going to be a big one because what does JP Morgan tell us? They tell us everything about the consumer. They tell us about commercial spending, capital investment, great, but most importantly, the consumer. How are credit card transactions going? How are bank balances going? Are people still flush with cash or not? Are they out of money? Those are going to be really important things to look for in that JP Morgan's earnings call on Wednesday. Really excited for that, and I'm going to be doing a dive deep into that earnings call so we can see what Jamie Dimon thinks about the market going forward. JP Morgan, as of about 2 months ago, had the recession odds at about 20%. Right now, economists are sitting at 27.5%, so we want to see, is JP Morgan going to exceed or come in under that 27.5% market expectation? If they come out and say, hey, the consumers are spending less already, and we're at 40% odds of a recession, big red flag. It's our first part of the earnings season, really bad indicator for the rest of the earnings season, and you're probably going to see a lot of hedging. And when you see hedges increase, what happens? Short interest goes up, and that puts selling pressure on stocks, bringing those prices down, right? So big report. JP Morgan's going to set the stage here. The banks always do. Now, flip side, if they come out and say, hey, don't worry, so far, it seems like the consumer is not reacting. The consumer still has high balances in their savings accounts or checking accounts or whatever. They've got plenty of money. They're still spending money like crazy, which it seems like they are. I mean, we're here at this Disney resort. Shout out to Disney. Phenomenal company. I'm a big investor in Disney as well. Their margins are absolutely wonderful. I think Q1 is going to be fantastic for Disney. It's going to be another important earnings call we want to look into. But if we get positivity from the banks, then I'm going to continue to expect positivity from the consumer brands as well. So we'll see. Then, of course, something else that's quite fascinating now is the 10-year real rate, which is we measure the real rate by looking at the inflation-protected TIPS version of the 10-year, just went positive. This is actually really interesting because anytime you get a positive real rates, you reduce demand for riskier assets. So when the last 2 years, we've been like negative 1.5% on the 10 years real rate, and that drives people into riskier assets, especially tech stocks. You get real rates going positive. People are like, hey, if I can get an actual yield, risk-free, well, then I don't need to be in risky assets, especially during a time where people are talking about a potential real estate housing bubble, which could substantially affect consumer demand. People are talking about just recessionary odds across the board as consumers spend less money relative to the end of Q4 2021. Coming up at Q4 2022, we'll have that year-over-year comparison. Of course, now we'll be comparing to the beginning of 2021. It's going to be really interesting. I'm not so worried about Q1 compared to Q1 of last year in terms of recessionary odds. I'm more worried about if we're going to see a recession, probably we would see that negative GDP era, Q4 of 2022. But here's the thing. Stocks do really well usually leading up to recessions and coming out of recessions. It's just a weird kind of in-between moment where stocks can really get hit hard. Now, you get some good buying opportunities, which is why I'm encouraging patience and saving cash, right? And spending less, which is ironic because then if everybody saved less, we would just self-fulfill a recession, right? But the other thing to keep in mind about the yield curve, actually, looking at the yield curve, I was looking at when the yield curve says we're going to see a recession, most people say within 18 months of an inversion. Well, guess what the historic fact is? 7 months to 4 years. It's like, what, are you going to be out of the market for that whole time? It's crazy. Anyway, this is my update for this week coming up. Thank you so much for watching. Make sure to subscribe. Use that coupon code CYBERKEVIN. Link down below for the programs on building your wealth. We'll see you in the next one.